When you look at the market correction, was it overdue? Was it overdue, and does it mean that actually we're just going to see a little bit more volatility, or does it mean that something ugly could happen anytime?
Yeah, I mean, I think a lot of people thought it was overdue when you look at the extent to which the U.S. was outperforming everyone else, the narrowness of the rally over the last several months. But I think we got a very clear catalyst. So, I mean, from that perspective, I don't really think that, I think if anything, the resilience of the market after the Powell speech was a little bit surprising. It took a few days, and finally the market keeled over. We're basically getting to a point in the cycle where volatility starts to go up as a function of the Fed getting into more hawkish territory. And that means equities are going to have somewhat of a tougher time.
Patrick, do you agree?
For me, I think U.S. equities are unequivocally overvalued. The growth stocks especially extremely valued. The Russell 2000 stocks, incredibly high indebtedness and very high valuations. But overall, just overvalued is the way I'd describe the whole U.S. equity market.
Patrick, I've been dying to talk to you. The basic theme of the last 48 hours has been from pros. They haven't seen the debt market break. The high yield market actually looks pretty solid. Do you buy the idea of distressed debt is an indicator of equity solidity?
I'm not so sure, actually. I think distressed debt is an indicator of the economy's strength. I actually don't have much doubts about the U.S. economy. I think it's going to continue to perform well, being driven by a late-cycle fiscal stimulus. My worry about equities are on the valuation side of things. So I'm not worried about the fundamentals of equities rolling over, about earnings rapidly deteriorating. It's just they're priced for perfection, and you rarely get perfection for such an extended period. We've had a perfection period for the last 12 to 18 months in terms of tax cuts, fiscal stimulus, earnings growing, operating margins reaching record high. I think the margins is where my worries are on equities rather than the economy. You look at interest rates, it's moving higher. You look at wage growth, it's moving higher. There's a lot of things that have been tailwinds for margins. I think they turn into headwinds in the coming months.
Gene, you work for a big institution, Pimco. They own all the bonds in Asia and half the bonds in Europe. I understand that. The basic theme is remain calm, carry on, and all that. Should we remain calm? I mean, there's an institutional effort to jawbone this thing forward, but what's the reality at Pimco? Are you going to cash?
Yeah, I mean, I think I said on this program a couple months ago,
we wrote it down. We know that.
You know that one. Okay, that's good. So I'd say we're still short certainty. I think we're at a point in the cycle where bond market volatility, which tends to feed through to other asset classes, is still reasonably underpriced. It's the point in the cycle when that should start to pick up. You know, we continue to see policy divergence between the U.S. and the rest of the world. That creates volatility, uncertainty. And to Francine's point, story of the day, China, there's a lot of uncertainty in China right now. I mean, you're basically starting to see the currency become a little bit more unhinged, as we think it should, in an environment of slowing growth. China is probably the most important vol suppression story in the world, and it has been for years. So to the extent that that's starting to come a little bit unstuck, it's telling us to be a little bit more careful on everything.
Gene, what do you mean about a little bit unstuck? Is it a good unstuck or is it a bad unstuck? Could it all go horribly wrong?
Well, you never know until after the fact. I mean, I think, so, my joke is whenever you're trying to deal with the leverage problem, the time to be worried is so if you have a leverage problem, the time to be worried is when you're actually dealing with it. And that's what China's trying to do. So beyond the whole trade dispute, there's really this story of China trying to manage a gradual deleveraging process. And that means a weaker currency. It means you need to let a little bit of pressure out everywhere. The Fed cycle makes that more challenging because ultimately China wants to be easing into this. Instead, they're having to focus more on fiscal policy. So I think China also has an intention to make the currency more volatile over time. And from that perspective, I would say it's going to be difficult to avoid it being a bad unstuck.
Okay, what's your take on it?
There's going to be volatility in the currency. They've managed it incredibly well for the last decade, really. The currency's performed exactly as they've wanted. It's been gradual moves, maybe except for August a couple of years ago. And that's really what China's wanted, to create an orderly move in the currency. They swing it to rising against the dollar or falling against the dollar as it suits them. But it gets unhinged at some point, and against the backdrop of higher rates in the U.S. And if we do get a slowing economy or credit issues in China, I think that's when you'll start to see maybe real volatility there.
2 days in a row, Gene, we've heard a rationalization that the equity markets are linked to China. Overnight, we see substantial jump condition, China weakness in the yuan, and of course, no manipulation by the government. Do the equity markets in the United States hinge on China growth and China action?
I mean, I think that's one variable, but I don't think it's the most important variable. I think it would become the most important variable if you actually started to see, the Chinese economy coming unstuck, and so far they're managing it pretty well. So from that perspective, I would say, China's a risk factor, but I don't think it's been at all the key driver of this sell-off.